thanks for those of you attending. I look forward to, to meeting you, and kind of like Andrew said, I'll give a little bit of my background and then we'll kind of jump right into it. So I've been in lending for 20 years, been doing construction lending for about 10 of those, and we've done probably about over 400 construction loan transactions. So we are pretty well versed, and the reason I bring that up, experience matters in today's market, because I had a call just earlier this morning, and the client asked me about 3 times the same question. Are you sure you do construction lending? And that was essentially prefaced because he has heard a lot of banks have exited, lending or construction lending. And kind of what Andrew had indicated is there is a lot of uncertainty, a lot of volatility in the market. And obviously with the rapid rise in interest rates, it's put banks out of business. It's just put, builders, banks, real estate, in a tough position. And from a consumer standpoint, it's created a lot of concern and uncertainty about what move, should I make? And it's hard, when we were thinking about what value we can add and bring. Everyone, when it comes to construction and building, comes from a different place. So I will preface by saying, take a shopping cart kind of method. We'll share some high level, some basic information. Some you may or may not already know. Some might be helpful. And then, of course, I think the value will be in, depending on wherever you're at, we're always going to be available, after this webinar for more questions, answers as you are considering possibly building, or just wherever you're at in the process. So I did have put together a little presentation here so I can stay on track, and will hopefully be helpful for you. So let me see if this comes through here. And Andrew, let me know if this screen share is working.
Looks good. Yep.
Okay, cool. So as we'd indicated, there's in the webinar, there's about 5 critical elements or qualifications from the lending standpoint. So I'll just kind of jump right into those. Again, some of you have already maybe done a construction loan or done financing, so it might be a little bit redundant, but I'll kind of weave in some of the new things and some things that lenders are maybe scrutinizing more given the current market. So let's see here. There we go. So I just start with, what is a construction loan? For those of you that may not know, I'll just read it. The definition of construction loan is a short-term loan that provides financing to cover the cost of building a home. Construction loans generally do have higher interest rates during the construction phase, where the money borrowed is provided in a series of draws or advances based on work complete. And during that construction build time frame is when you as a consumer client are going to be paying interest on the draw portion of the loan. But that's kind of the basic definition. I'd start there. We can get into the intricacies, not on this webinar, but on different types of construction loans. But generally speaking, that is really what it entails. So one of the criteria for qualifying is, of course, having a solid credit history and score. So minimum score is 700. That's based upon Fannie Mae. Fannie Mae, the government-sponsored entity, requires a minimum credit score of 700. There are exceptions, based on an overall consumer's credit worthiness. They might have, let's say, a 680, but have other compensating factors, like maybe you've got a lot of equity in the transaction or a lot of reserves and liquidity that might help, where a lender might make an exception for that. If it's a jumbo loan, that typically requires a higher credit score, about a 720. And then some other additional credit considerations are, of course, the amount of consumer revolving debt, any past derogatory credit and collections and bankruptcies. Usually it's about 4 years from bankruptcy that lenders look at for getting approval for a construction financing, and 7 years from foreclosure. And then debt to income ratio requirements for a construction loan are typically a little bit more stringent than just a regular if you were to purchase an existing home. So again, construction loans are a little bit more risky to banking institutions. Number two, so it's important to have, of course, a detailed construction plan and budget. One of the things that lenders look at, is having, a very clear understanding of the scope of work, the building time frame. Generally, a construction build on average is about 12 months to 18, for a higher end custom construction build time frame. So materials, labor costs, those are all other additional considerations. The other is a realistic, feasible budget. So I will tell you that is under a lot of scrutiny right now. So coming through the pandemic, where pricing volatility, and I think Andrew might touch on this a little bit later, pricing volatility was nuts. It was literally about every other day I would get a call from, a client that has closed a construction loan, and I get a call from either the builder or client like, hey, we're under budget. What can we do? So luckily right now in this time frame, we aren't experiencing the volatility that was prevalent in that pandemic era and just coming out of it in 22, if you will. But that is what led to contingency requirements. And all a contingency is, and it's really important when you hear that word thrown out, it's just call it a slush fund for any cost overruns. So when you receive a budget from a builder, sometimes a builder will include a contingency and or the lender will include that contingency. And so it's really important. It really just, I call it insurance. It protects you as a consumer from any cost overruns. And if you don't use it, it is just, it's a principal reduction at the end, but it's really important. And it gives lenders peace of mind. It now gives builders who sometimes now require it peace of mind. And of course, you as a consumer, peace of mind as well, knowing that you have coverage for any of those cost overruns, unforeseen cost overruns. Number three is a question, what are the down payment or equity requirements? Again, some of you may or may not own the land, or if you're going to be purchasing land and so forth. So again, we won't get into the details, but there's a few different places that you can enter into the construction. It's either you can be purchasing land and maybe closing simultaneously on a construction loan, which is very rare, but that can happen. You maybe already own the land, maybe you own it outright, maybe you have a loan, on it. And then there's also just land acquisition. So a lot of times, if you don't own the land, ideally you're going to acquire the land with cash or with some type of financing. It could be an equity line or a land loan, out there to acquire the loan. I call that acquire the land. I call that kind of phase one. And then you move into building out your construction exhibits, putting together your plans, specifications, and so forth. But the general loan to value requirements are, if it's a conventional loan, you need to have at least 5% equity. So it's about, 95% loan to value. For a jumbo loan, again, that's over that $766,500 loan amount. The requirements for a down payment or equity position are a little bit greater, anywhere from 10 to 20%. And of course, if you're getting into the larger loan sizes, generally about $1.5 million. I know I said, $1.25 million, but about $1.5 million and above, typically 25%, plus of equity position or down payment would be required. Now I put a star next to the currently own a home. So the number one question I typically get is, is if you're a homeowner, majority are, but then you're wanting to build is, how do I either capture, equity, or do I need to sell my home first, or can I live in my home until the build is complete? So we don't have time on this webinar to go through all of those details because everyone's position is going to be unique. But there is avenues to do all of the above, whether it's capture some equity, to acquire the land, whether it's building while you live in your home, that is an option. But one thing I wanted to touch on is the conversion of a current home to an investment property. So we could do a whole webinar on this, but for those of you that own a home and are sitting on a 3 and 4% interest rate, it would behoove you to do a deep evaluation on what it would look like to convert that property to an investment and looking at the long-term wealth strategy behind that. Why? Because we're probably never going to see 3 and 4% interest rates again in our lifetime. So again, I just wanted to put that bug in your ear because it's a conversation as we look at, as I would say, our team looks at more of a holistic view with our clients of wealth building when it comes to real estate. So, and again, I'll maybe save that for some of the Q&A question if you guys have questions on that. The fourth is working with an experienced builder like Creekside Homes. So I just had a call today, and it's really interesting that, a lot of builders have kind of put a pause on building just because of the high interest rate. So if a builder is needing, let's say financing to build homes, spec financing and so forth, or they have maybe small developments and so forth, the cost of borrowing funds out there is incredibly expensive. So there's been definitely a slowdown. Hasn't stopped. Why? Because inventory is incredibly low. That's what's held prices and will continue to hold home values and prices because there's just not enough inventory to meet the demand. And so some of the things that we as lenders evaluate, track record, length of time in business, their financial stability, current and recent activity, licensing, and if there's any, lien, kind of their lien status, if they had any prior, liens that subs had placed on them. But I would say the most important right now is just current and recent activity. Are they actively building in the market, and do they have those current supplier vendor relationships that are ongoing? That's a really important thing, and it's important for you as a customer when you're evaluating, builders, is to ask those important questions. So one of the things that we really like working with Creekside is because they fulfill all of those things above and beyond. So and lastly here in R5 is appraisal and collateral. So common question I have, when we're going through the construction process as well, how do you determine the value, or how do you appraise a home if it's dirt? And what lenders do is what is called a subject to completion value. So we evaluate all of the construction exhibits, your plans, your specifications, construction contract and budget, and then an appraiser is going to go out there, and it's kind of a 2-for-1. They will evaluate the value of the land, and then they're evaluating comparable sales that are most similar to what you're going to build. So if you're building on 5 acres, a 3,000 square foot, ranch style home with X amenities, they're going to be looking for comparable sales that are most similar to that to determine the value of your subject property. And then, lastly, of course, the appraisal will impact the loan terms, kind of back to what the loan to value requirements are and so forth. So that is just kind of one of the fifth and major qualifiers when it comes to construction financing. This deck, I call it a bonus deck. You can maybe take a screenshot of this, but this is the all-encompassing high-level overview of the construction loan process. You start with the most important really is the pre-approval, which is determining your budget that you could then take to, Creekside and your builder and, say, hey, this is roughly what we're looking at. How can we build what we want and stay within this budget? And then it comes to selecting a home site, collaborating with Creekside to compile your plans, specifications, contract, and budget. And then we move to obtaining an appraisal. We close the loan. Then you're building for the next 8, 12, 18 months. I don't think it may last that long, but within that time frame. And then lastly, it's loan modification and conversion to permanent. So that's kind of, I call it the Goodyear blimp overview when you're thinking, okay, well, where do I even start in this process? That's kind of the A to Z 7-step process. So I'll save the questions for Q&A, but one of the things that we had indicated we'd talk about on this call, because it's a very common question and concern, is interest rates. So I had put this slide in here. So this is where interest rates, so currently today we're sitting around 7 1/8, 7 1/4 for a conventional 30-year fixed rate. That is the going 30-year fixed average. And as you can see from the chart, these were, our dream rates that we're probably never going to see again in the 3 and 4% range. And we peaked in October at about 8%. That's when, the kind of real estate didn't come to a halt because again, there's no inventory, but it's slowed down considerably. And then it's come back down. We touched into the mid sixes range and we've gone back up. Why have we gone back up? Well, because we're going to see a very volatile year with mixed data. I've got the next slide, actually, I'll touch on that. But we're going to see a little volatility, I think, in this range for a majority of this year. And what are the experts predicting? So anywhere from the National Association of Realtors to Bank of America, Mortgage Bankers Association, they're thinking rates are going to be by the end of 24, maybe in the low sixes, low to mid six range. My personal prediction, is that probably that mid to low six range is probably where we'll end up, just because there's a lot more volatility that we're seeing in the market with the data that's coming out in regards to inflation, which is what the Fed is determining will make their case for lowering interest rates. So,
hey, Matt, I have a quick question.
Yeah.
On that rate reference to where the rate will be or is now, can you clarify? Because I think that that when we say the rate, I think we're talking about like a 30-year mortgage rate at zero cost or something like that. And then, like the potential is always, and you're the expert at this, but like you could buy a point, like you could buy 1 point down on that rate for X number of dollars. And I've heard people make a reference to like, if it's possible to buy into the fives, a lot of people would probably find a way to make a deal work or something. Could you comment on that a little?
Yeah, good question. So this is pulled, first of all, from Mortgage News Daily. Maybe I didn't have that on there, but anyone, and I always recommend every client of mine, you can go to Mortgage News Daily. Mortgage News Daily will have a rate tracker survey, if you will, and it's pulled from hundreds of different lenders that report that data. And so there's an average, and the average, roughly around 7.25 is give or take about, no points. So every lender is going to be, we get money from the same place, right? So it's going to be within a range. And so I would say, to answer a question directly, that 7.25 is close to about a no points, but it depends on the lender. That 7.25 might come with a little bit of a discount point or not. And then from that point, in terms of buying down the rate, you can absolutely buy down an interest rate further. And if you are looking at a lot of builders, if you were just going to be purchasing a home from, let's just say D.R. Horton, for example, right? So D.R. Horton, they offer a lot of incentives when it comes to an interest rate, right? Because they actually own the mortgage company. There's a whole nother segment on that, but they'll do maybe a temporary buy down. They might do a permanent buy down where you can take a seller concession and buy that, the going rate of, let's say, 7.25 with no points to down to 6%, and it might cost you two points. What are points? It's a percentage of the loan amount. Okay. So I don't know if that answers the question. I could go on more detail, but that's generally what, when I say the going rate, yeah, it's roughly about give or take no points. And then you could buy down further from there if you wanted to get a below market rate.
That's great. So you would be able to help folks determine what option is best for them and how to best use their available cash to get the best payment and overall terms for what they're trying to do.
Yeah, my general consensus as well right now is that there's rates are going to come down. They will. And so everyone's situation is different, but generally speaking, I wouldn't recommend significantly buying down an interest rate right now because it's going to be short term. And if you're talking about building, that's a whole different animal because you've got rates today and there's a very strong likelihood that rates will be, well, I mean, with all of the predictions, right, that they'll be lower. So let's say if you're going to be breaking ground today and building and wrapping up by, end or early 2025, rates are probably going to be lower by then. So, you don't probably want to buy down a rate that's going to only be temporary anyway. But again, everyone's situation is different. We absolutely, discuss that with every client. So
great, thank you.
Yeah. So, what we do know, Fed's goal is 2% inflation. We're not there yet. The CPI, what is CPI? It stands for Consumer Price Index. There's many different, but that is one of the major inflation indicators and reports that the Fed is looking at. And so as you can see here, it's coming down. About 40% of the CPI report is made up of shelter costs. What are shelter costs? That's housing. And so, if you've got if you on this call have, any rental properties or been renting, the rents have skyrocketed. They have now stabilized, and if not stabilized, have kind of been coming down actually, or at least stabilized depending on the market, of course. So we're seeing a lot of those come down. I had a down arrow, but it's mixed. Okay, the reason rates jumped up a little bit just this year are because of a strong jobs report. Well, what's interesting is, and I could go on to the weeds on this one, is a report will come out, the Fed will react, they'll base their decisions on that, and then the report will be revised. And and so, that's where when I say there's going to be volatility in the market, it's because we're going to see so much mixed data, and it'll be interesting, right? But overall, when you look at the consumer debt, is at an all-time high. Student loan repayment just started back up again in October. We've got an election year. It's just if you just talk to the average business owner or consumer out there, I mean, stuff is expensive. It's like, how can you keep this up? So and then there's a whole commercial real estate, market that is there's going to be a lot of pain in that market. So the Fed wants, it's interesting. I mean, they want higher unemployment, right? Unemployment's really low. They want higher unemployment. They want lower, because that will help in, lowering inflation, So basically, when there's more pain in the economy, that actually will lead to lower interest rates, right? Because the Fed is, of course, just trying to play the balance. So, but everything that we're seeing, the point is that, we're probably heading for lower interest rates. Don't know exactly when. But it's coming. So, so my last slide here was slide I found with Warren Buffett. I was listening to a podcast. It was a short one, and he I just like this quote: "Market fluctuations are your friend, not your enemy." That the number one question that one of the number one questions that I get when it comes to building is, should I build right now? Well, interest rates are high, costs seem high, everything seems high. Should I build right now? And everyone's situation is unique and different, but my perspective is there's been a slowdown. And if rates are going to go down, you're going to see another frenzy, and that will drive costs up. It will, at the end of the day, it'll drive costs up. So I think when you are considering building, I think now is a good time, in the fact that if you can get ahead of the curve in terms of the potential for that frenzy again that we saw in 21, 22, the multiple offers with price volatility, all of that. Now is a pretty good time. And then hopefully you catch the cycle of, rates then coming down as you're nearing completion. Don't have the crystal ball, and as Warren Buffett said, essentially in this whole quote, essentially it's just, you just got to plan for the now, build and plan on your, the present time for your situation, and then move forward accordingly. So that's what I got. I know that was a lot maybe to digest and swallow. So I'll kick it back over to you, Andrew.
All right, great. I would like to know if anybody has any questions on that here before I show a couple things. I have less slides than Matt did, so
sorry.
No, that was great. But if anybody has a question, let's see. I've got Paul raising his hand. How do we unmute you here, Paul? There you are.
Can you hear me?
Yeah.
Hey, it's Paul Maddox. Hey, Matt, I have a question. Do you also offer HELOCs? And can you maybe quickly outline the advantage of a HELOC versus a construction loan? One versus the other?
Yeah. So if you've got maybe let me fire some questions back. So, I mean, yes, we do offer home equity lines of credit, and our bank specifically is smaller. We're based out of Seattle, so sometimes we may be a good fit, but I do have other resources that I would recommend. It just a lot of, factors there. So are you saying, I mean, if you have, let me just say this, if you have the capacity to use a home equity line of credit to build, that's a great way to go because it's less cost than a construction loan, and it's like you're building it out of your own. It's just like a capital line that you have. So I think that is a great option. However, my next question would be, what are you going to do at the end? Like, what is your plan for permanent financing?
There's a plan for permanent financing. So I guess I know what. So pay off a HELOC, pay off a construction loan, wherever the money is coming from is the same, right?
Well, here, let me.
I guess really what I'm kind of getting to is looking at the construction loan. Looked like there was a lot of reporting and tracking. Are we on schedule before you get your next bundle of money? A HELOC typically isn't going to have that, right? So is it easier to go that way, or?
Well, and are you talking about a HELOC just on the subject property? Because the HELOC would need to be on an existing home and property.
Right. Yeah, no. So say, I guess in my particular interest is to do a big expansion on a home. So a HELOC against the existing home equity.
Oh, if you've got enough equity, because it's going to be based on your current loan to value, not the projected value after after the addition is complete. So if you have enough equity, yes, in this current rate environment, I'd probably do an equity line, and then you could look at consolidating it, refinancing, combining it, together. HELOC rates are tied to prime, which is 8.5. So your HELOC rates are probably going to be 9+%. I mean, I have a HELOC, it's 9 or 9.25. So you don't want that. You don't want to hang on to that forever. And that's why I asked about
rates are high. HELOC rates are higher than construction rates right now.
For sure. Yeah.
Which are higher than just a conventional loan.
Yep.
Right? Okay.
Yep.
All right. That's kind of what I was getting at. All right. Thank you.
Yeah.
Awesome. Thank you. Anybody else have a quick question for Matt? Before we move to the next here. And if you do, you can unmute and speak or raise your hand or whatever there. And I'll pull up a couple things here to share. Okay. So there was a couple things that Matt referred to. One of the things that he referred to was the some of the timelines. So we've kind of mapped out the phase. I hope everybody can see this okay, but we mapped out the process of what it takes to get a house through the design and build phase. And on the left, we have the dream, where somebody has this idea they would like to achieve, whether it's an addition on their existing home or it's building on a new property. And so we've broken it down. This is, I'll show you the detailed view, but this is the big overview. We start by planning out the space and getting a basic spec understanding, and then we get the concept approved. Once the concept is approved, we sign off on that, and we price out the project at that point. We include allowances for finishes that are based on the way the meetings have gone and the discussions have gone, and then you know what it's going to cost to move forward. Once you're ready to move forward, we have you select all the actual colors and finishes and everything with our designers and architects and our team that we've put together for that. And so at that point, we can move into the permitting phase. Now, the permitting phase is very wide open. It can take 2 weeks to 6 months, depending on the jurisdiction. And so we can advise you back at the dream stage, where you're looking for land, or if you already have the land, what it'll probably take to get through that based on the location. But then we can move quickly into a pre-construction meeting while the permits, and this is also, by the way, the time to we can get all the docs to Matt so that he can get your loan closed. And so these timeframes can run concurrent with each other, where the permits are being applied for and your financing is getting closed. Then we can break ground, and we like to have you on site for that and celebrate the start of the project. And then the next time we need you on site is at the rough-in review, where you get to come out and see the house framed up, the electrical, plumbing, and HVAC getting installed, and you get to confirm things, get a kind of a review of everything before the drywall. We do another on-site review of the paint colors to verify that the colors work with everything together before we do all the painting. So when drywall and siding are up, we put up samples so that you can approve that on site. And then the last thing we have is we do a walkthrough near completion. Right before we do the final clean, we kind of get you oriented with where everything is and go over everything. And then we do a final handoff once the final cleaning and punch items are done. You'll notice that it doesn't stop at the move-in, but we continue to follow up with you and make sure that the home is performing well and as expected. So we have a 30-day check-in, a 3-month review, and an 11-month review. And then we continue to stay in touch with seasonal maintenance, tips and reminders as well. So that's just a quick overview of how this process flows. Just for your information, we do have a lot more detail into how all of this goes and who does what in our team to get this accomplished. This is just the dream phase for us. We've mapped out every step of it. And then again, in the build phase, of course, that's the real complicated part, but we've got every step of the process mapped out. And you'll see that, we've got the client walkthrough built into our schedule for the different phases. We've got the green boxes that indicate our QC reports that we do. So our project managers are following a written quality control process all the way through. So this just gives this is a way to illustrate that we've worked hard to think all of that through. And the last thing I'll share with you is the roller coaster. We call this the 10-step emotional roller coaster because it can be a lot of fun. So when you get started, usually you're super excited and we have this dream in mind. We start getting into design, finishes, pricing, contract, and then see some stuff happen on site, and it's exciting to see it all start happening. And then the details, it can be dirty, it can be there can be a lot of things that, you don't have to actually get this bummed out, but it definitely at sheetrock stage can sometimes feel a little wearying. And then you're on the upswing with the finishes and the walkthrough and final walkthrough and closing. And our goal is to have you at least at the same level that you were at the beginning with that dream when you move in. And so we've learned to manage kind of through all of these ups and downs and put systems in place to communicate well and to try to limit the volatility and the feeling of all of that. So those are just some things that I wanted to share with everybody. I think some of the big questions that we've talked about with the that what is it the right time and all that, and Matt did do a little allusion or a little talk about that, and you brought some good points. I also have had like our lumber supplier told me the other day that he has over $1 million in lumber orders that have been put on the sideline waiting for interest rates to come down. And so when interest rates hit whatever that magical point is that those people have allocated, they're going to order that lumber. And so that much lumber getting ordered that's a lot of lumber, especially at lumber prices now, which have actually gotten back to 2019 levels. So lumber had shot up and had gotten really expensive in 2020, 2021, but it's now back down to those levels that we were used to for several years, which is a good thing. But there is a potential that volatility could end up making things tricky in the future. So that's why we're saying, it's a good time. When we made a reference here to Warren Buffett, and one of the things a lot of these really seasoned investors will say is, don't do what everyone else is doing in the market. So if everybody's selling their house, it's not a good time to sell your house because there's so much competition. A good time to sell is when you can't find a house for sale, and so then you list your house and it's got a lot of demand. It's kind of the same in this case. When there's not a lot of construction, when there seems to be a little break in construction, vendors tend to get a little more hungry on their labor prices. Various things like lumber that are a commoditized item can certainly get better in price. So we've also seen a large cabinet manufacturer that's got several locations across the country send us a notice the other day that they are easing up their pricing to remain competitive. And that's the first time I've heard that in, I don't know, 10, 15 years maybe. To hear somebody like that, because again, lumber goes up and down, but everything else pretty much just creeps up slowly over time. And in the last couple of years, sometimes it jumps up, but they're actually starting to soften some numbers. So I think for those reasons, it's definitely worth considering. And I think that finding these new values and where the market is currently, I think they're going to just be further supported by time going by. One other data point I'll leave you with is I was listening to the Toll Brothers CEO, Doug Yearley, on a podcast this week. And he made a comment that we are 6 million homes behind demand nationwide. And so we're not, and he said at the rate we're going, we're not even coming close to that, to being on pace to meet that demand. What that does give us is an understanding that real estate is going to remain strong, even in spite of tough economic times. There's just a need for housing. There's a shortage for housing. Our governor is currently working to try to actually change the zoning, the historic EFU zone requirements for the state. She's actually working with both sides at the Capitol to try to come up with a common sense solution that releases a lot more land to be available to build on, because again of this big shortage that we have. So some really interesting things there to bring to your attention, and I hope that's been helpful, and certainly open to any other questions that anyone may have about these things, and here to help you. Does anyone have any questions for Matt or myself? We'd love to connect with each one of you, even individually, if you don't want to talk on the call here, but certainly want to be helpful. And if anybody is looking to make any moves, we'd love to help you with that. Matt, do you have any other thoughts here as we wrap up?
No, just yeah, we've got, construction is a process. I call it it's a marriage. You're marrying your builder and typically the lender for a couple years, at least. So it's so choose wisely. But no, that's why we love working together. It's why, Andrew and I have formed a good relationship because it's really important. You want a good team. We press on having a good financial team for our clients, having a financial advisor, a good CPA, a good insurance agent, from that holistic financial, profile. And then when it comes to building, the trifecta of a builder, your lender, even a real estate agent, if you're looking for land, all being on the same page is really critical, because there's so many moving parts. So we love it. Construction, to the point I was thinking, Andrew, about what you'd said on the shortage. I also just listened to a podcast, Ken McElroy, and one of the things that, and this is definitely not a political statement, but there was a graph that he showed that this, for the first time in history, illegal immigration had exceeded birth rates in the U.S. So, regardless of, that the housing, shortage is definitely, a challenge, across the board. Every municipality is trying to deal with it, and of course, just the cost to build. So, yeah, anyway. So
yeah, that's a good point. And that's definitely going to put pressure on most levels of housing, right? Because these people that are coming in do have to stay somewhere. And I know there's a lot of like temporary hotel type of things being done, but those are temporary solutions. So long-term solutions are being put in place, but that's also going to give rise in value to affordable properties that these people come in and become eligible to afford, and then that moves on up the ladder. So
yep.
Yeah, there's definitely a big shift going on right now in our population. And if we're already 6 million units behind, and to whatever the numbers are, it's hard to track illegal immigration, but whatever the numbers are of new people in the country, if it's millions more people, then we're obviously just building more of a deficit at that point. So
yeah. But yeah, I'll just leave you with, if anyone has any questions, wants to reach out to me individually, perfect, personal situation. Again, whether or not, you're building, want to build now or want to build in years to come, I would say it's never too late to start engaging and gathering information, and that's what we're here for. So, yeah.
Absolutely. Well, thank you everyone for joining us today. And if no one has any other questions for us, we'll go ahead and sign off, and we'll share with you the recording and the information, so you'll make sure you guys have both our contact info, and look forward to working with you soon.
Thank you.
Yeah. Thanks everyone for attending.